All right, Chapter 39, talk a little bit about the balance of payments, exchange rates, and trade deficits. The United States has an open economy, so they engage in international trade. And so when they import, export goods and services to other countries, there is also an exchange of currency. And so if Ford, for example, exports cars to China, China has to convert their currency in the foreign exchange market to dollars, and then they pay the United States in dollars. So there's been an export of a good and an import of cash in the economy. And with the cash the U.S. receives, they can buy, Chinese stock, for example, or a Chinese bond. We'll talk a little bit more about this and show how this balances the balance of payments. Also, people can buy or sell real or financial assets to foreigners. Can buy foreign stock. We can also sell our house to a foreigner, and when we do that, we acquire the foreign currency as well. Okay, so the balance of payments has current account and then capital and financial account, and the two of them are equal to each other. Okay. And overall, it is the sum of international financial transactions. So what the current account does is it takes into account how much goods the U.S. exports, or the value of the goods U.S. exports in a dollar amount. How many goods in a dollar amount the U.S. imports. They do the same for services. They also look at net investment income. So U.S. citizens have capital abroad and foreigners have capital in the U.S. And so U.S. citizens receive interest and dividends from the capital abroad, and then foreigners will receive interest and dividends from their capital in the United States. Okay, and so the difference between the two is the net investment income. Also, it looks at net transfers. So this is the amount of foreign aid that goes out of the United States to other countries. Also, pensions paid to any U.S. citizens that are living out of the country, and the money that immigrants sent to relatives back home. So when we add all of this up, we have the balance on the current account. The capital account measures debt forgiveness. How much debt did foreigners forgive that was owed to them by U.S. citizens, minus how much debt that Americans forgave that was owed to them by foreigners. And then the financial account summarizes international asset transactions. So look at how many foreign stocks and bonds that a U.S. citizen has, and how many U.S. stocks and bonds that a foreign citizen has. And so the current account added to the capital account and financial account, the balance of payments will come out to be 0. All right, long story short, whenever we import a good or export a good, there is an exchange of money there. So the current account changes by the amount of the value of the import or exports, and then the financial account will change by that amount too. So, if we import $10,000 worth of Chinese goods, then the current account goes down by 10,000, and since we pay for these Chinese goods in US dollars, and this is an asset, then what ends up happening is the financial account goes down by $10,000 as well. So you can look at it as current account looks at the exchange of goods and services, and capital and financial account looks at the exchange of money. Now, some of the foreign purchases of assets in the U.S. and the U.S. assets purchased abroad are official reserves of a country's central bank. And that is done to bring the current accounts in balance with capital and financial accounts. Okay, so this is the balance of payments in the United States in 2012. And so you can see that they balance out. Okay, and that the sum of them equals 0. Okay, the United States exported $1.5 trillion worth of goods. It also exported $630 billion of services, and you can see they imported $2.3 trillion of goods and imported $435 billion of services. And so we had a trade deficit of $540 billion in 2012, and we import more than we export. And this also increases the amount of debt that U.S. citizens owe to the rest of the world. When we import a good, we use American dollars to purchase those goods, and therefore foreign citizens own a lot of American assets as well. And this shows this is a debt to the United States. Whenever a foreign citizen buys a U.S. bond, for example, then the U.S. is indebted to that bondholder. Okay, as mentioned before, with official reserves, this is a mix of foreign currencies. Some reserves are deposited with the IMF, which is the International Monetary Fund, and then they also have some gold as well. And as mentioned before, this is used by the central bank or the government to make sure that the balance of payments balance out to 0. Okay, so if we look here, U.S. trade balances and goods and services. So we export more goods and services than we import to Australia, Belgium, Brazil, Singapore, and United Kingdom, but we import more goods than we export to China, Germany, Japan, South Korea, and Mexico. And so China here is one of the reasons we've had such a large trade deficit. Okay, so flexible exchange rates, we're looking at the supply and demand of a country's money, and they can rise or fall because there's no currency intervention. Sometimes you'll see these referred to as a floating exchange rate. So this is the market for foreign currency in pounds. Okay, so we have the demand for pounds, okay, downward sloping. Why? Because over here on the vertical axis, we see dollar price of 1 pound. Okay, so as the price to buy a pound decreases, then U.S. citizens will demand a higher amount of pounds in order to be able to buy British exports. Okay, but as the price to buy a pound increases, okay, then demand for pounds, or quantity demanded for pounds, decreases because now British goods are more expensive relative to foreign goods. So as the price of buying 1 pound rises, we say that the dollar is depreciating against the pound. Okay, it's losing value. So if the price was $2 for 1 pound, and then the price went to $3 for 1 pound, then the dollar has depreciated against the pound, and therefore the pound appreciates against the dollar. And if the price were to go from 2 to 1, then we would say the dollar appreciates, it gains value against the pound, and therefore the pound depreciates or loses value against the dollar. So the more of one currency it takes to buy another currency, then the original currency will depreciate. So if it takes more of currency A to buy currency B, then currency A has depreciated against currency B. But if it takes less of one currency than before to buy the second currency, then we'll say currency A has appreciated against currency B. Okay, so here we have the supply of pounds. Okay, and so it's upward sloping. Why? Because let's say we start off at $2 for a pound, and then the dollar depreciates against the pound, and now it takes $3 to buy a pound. Okay, so the British are willing to exchange a higher quantity or supply a higher quantity of pounds in order to buy dollars, because now US goods are cheaper relative to British goods. So the dollar has dropped in value, and so the British can now buy more American goods and services than before. So they're willing to supply a higher quantity of pounds in order to buy American dollars, because now American dollars are cheaper, and therefore they can buy cheaper American exports. And then the reverse would be true. If it went from $2 for a pound to $1 for a pound, then the British are going to supply less pounds, because now American goods are more expensive relative to British goods, and so they're not as willing to buy American exports, and therefore they don't sell or supply a lot of pounds in the market. And so it's the forces of supply and demand of a currency that set the exchange rate here. So what we have equilibrium is the exchange rate is $2 for 1 pound. Then we have the equilibrium of Q1 pounds. Okay, so all things equal, if the demand for a certain nation's currency increases, then that currency will appreciate. If the demand decreases, that currency will depreciate. Also, if the supply of a nation's currency increases, then that currency will depreciate. If the supply decreases, then that currency will appreciate. And also, if a certain nation's currency appreciates, then all other things equal, the foreign currency will depreciate against it. Okay, so things that shift supply and demand, it could be change in tastes. So if, for example, in the United States, very innovative, and so a lot of people like, for example, Apple products, and so they may demand a lot of dollars in order to buy Apple products, and so that will appreciate the US dollar. Any type of income changes, so as a country becomes more prosperous and their income rises, then people want to buy more domestic goods and foreign goods. So the demand for foreign currency will increase, therefore the dollar will depreciate against the foreign currency. Okay. The relative price level changes is based on purchasing power parity. And what this is, for example, if a latte costs $4 in the United States, since a latte is the same in the United States as it is, let's say, in the UK, and let's say it costs £2 in the UK, then we can find the exchange rate by dividing price of the latte in the US, price of the latte in the UK, and we get that it takes $2 to buy 1 pound. Okay. Now, it doesn't necessarily hold true, because there's other factors why a latte may be more expensive somewhere. But what it does show is that if we're looking at the inflation rate in the United States versus the inflation rate in the UK, if the United States has a higher inflation rate, then the dollar depreciates against the pound, and if UK has a higher inflation rate, then the pound depreciates against the dollar. Also, relative interest rates. If a US bond is paying, for example, 1%, and a UK bond is paying 3%, then US citizens will demand pounds in order to buy UK bonds since they offer a higher rate of return. And this will appreciate the pound against the dollar. And speculation, if someone expects the pound to appreciate in the future, then they will try to buy more pounds today since they're relatively cheaper. So that way they can sell them at a higher price in the future. And so that would, for example, appreciate the pound. Okay, so under flexible exchange rates, if there's an increase in the demand for pounds, let's say US income rose, and so US citizens now want to buy more British goods, so they demand more pounds, and what happens is that the dollar depreciates against the pound. So before it was $2 to buy a pound, now it's $3 to buy a pound, and the pound appreciates against the dollar. Now, if it were a fixed exchange rate, so for example, let's say no matter what, it will always take $2 to buy a pound, then what would happen is the shift from A to B, since it wouldn't be allowed to adjust to point C, then a balance of payments deficit will occur. We can see here that there's a higher demand for pounds than there is a supply. And the United States could do several things to cover the shortage. They can sell some of their reserves of pounds, so that would increase the supply to bring it back to equilibrium. So it will shift to the right. Okay. Or they can also restrict trade, so that way the demand for pounds wouldn't be so high. They can have exchange controls, or even go on contractionary fiscal and monetary policy. So with flexible exchange rates, supply and demand are free to adjust to a new equilibrium, and this helps bring the balance of payments back to zero. But some of the disadvantages is that there is more volatility. Any type of political event or economic event can greatly appreciate or depreciate a country's currency in a short amount of time. Also, losses can occur. So, for example, let's say the U.S. sets a contract to buy a certain amount of foreign goods, but the price that is agreed upon is, let's say, again, $2 for a pound, but during that time, the exchange rate changes, and now it's $4 for a pound. And so the U.S. importer will end up paying a lot more than before, and that causes a lot of uncertainty and a fear of trade because it changes the terms of trade. And also, it can cause instability in certain industries. So, for example, if the U.S. is doing very well economically and the U.S. dollar depreciates against several currencies, then foreign demand for U.S. goods will rise since now U.S. imports are cheaper relative to foreign goods. And so this will increase spending and also increase U.S. prices. So we have inflation as a trade-off. And then all the prices of U.S. imports will increase. But if the dollar appreciates, then this drops U.S. exports, increases imports, and sometimes this can come off at trade-off with unemployment, since U.S. exports are not as in demand, less output is produced, and therefore people are laid off. Okay. We can see how many dollars it took to buy a pound from 1970. So before 1971, it used to be fixed at $2.40 by a pound, then it was allowed to float. And so you could see it's been a little volatile in the start, and then it's kind of stabilized for the most part. Okay, so as mentioned before, with the fixed exchange rates, what the government's trying to do is keep the exchange rate from fluctuating. So they try to keep it at, for example, $2 buys a pound. And in the example I did before, I said they can also buy reserves to do this. So if the demand for pounds increase, then the U.S. government can sell their reserves of pounds, therefore to bring it back into equilibrium. Let's say U.S. citizens want more UK goods, and so their demand for pounds increases. What the U.S. can do is discourage the demand for those imports by setting quotas or tariffs on imports from the UK. They can also have exchange controls, and this would be that if there's a shortage of the pound, then they require that any pounds that is obtained by U.S. exporters be sold to the federal government, and then they can reallocate those pounds to U.S. importers. Okay, and this causes a lot of issues. One, it distorts trade. We saw in another chapter why free trade is good and the benefits of trade, and how anytime there's a distortion, there's a deadweight loss. It also could lead to favoritism, where governments will start favoriting some importers over another, so they might impose tariffs on one importer but not to another. And then it would also limit the choice of the U.S. So if we were to put a quota or a tariff on foreign cars, then kind of limits our budget more to domestic cars. And then this also creates a black market, where importers will be willing to pay more than the official rates. And so this leads to black market dealings between sellers and importers, and that's technically illegal. They could also use contractionary monetary and fiscal policy to lower U.S. income, and therefore they demand less foreign goods, but the trade-off could be that a decreased GDP and potentially causing the country to go into a recession. So through 1879 to 1934, the United States was on a gold standard system. So the amount of dollars available in the economy was based on the amount of gold available. And it was a very rigid system. In order to be able to have more dollars, they would have to acquire gold. And they went to Bretton Woods in 1944, and it was similar to the gold standard, a little bit more flexible, but it was indirectly tied to gold. And so in order for the U.S. to keep spending money, then they would have to acquire more and more gold to have that money backed up by gold. And there was doubt that the U.S. could keep spending so much and be able to deliver on the gold. And so from the early 70s on, we went to a managed floats. So this is a flexible exchange system, but with the ability for our government to intervene if needed. So nations' currency worth is dependent on what's going on in the foreign exchange markers, whether there's demand for their currency or an oversupply of their currency. However, governments will occasionally intervene during economic crisis to stabilize their currency. Those in support of a managed float say that the country has more flexibility to deal with any type of crisis. The currency will, for example, depreciate during a more gradual period in times of economic decline, versus under a fixed exchange rate system, usually there will be a lot of pressure to devalue the currency, and once the country's central bank runs short of reserves to keep the currency pegged, then a sharp devaluation occurs and can cause hyperinflation. Because countries are tied together financially due to trade, some concerns with the managed float is that if one country starts having economic problems and their currency starts to depreciate, then their neighboring countries that they trade with will have the same problems, and so investors will pull their money out rapidly from these countries, causing a fast depreciation of these countries' currencies. And a lot of times they will require a bailout from the IMF. Also, they're susceptible to speculation as well. The United States, the last several years, has experienced large and persistent trade deficits. Part of it is due to high U.S. growth relative to other nations. So United States grew much faster than Japan and some other countries in Europe, and so demand for U.S. exports did not grow as much as demand for imports did. Also, the United States imports a lot of goods from China. However, the Chinese standard of living is not so high where they buy enough U.S. exports to cover how much we import from them. And also, they intervene in the market to keep their currency low relative to the dollar. And so this further causes a distortion where their goods and services are cheaper relative to our goods and services as well. We also import a large amount of oil, and so that's another reason for the trade deficits. And the U.S. has a low savings rate. U.S. investment spending was greater than savings, which meant that foreigners made up the difference. So a lot of that deficit is because foreigners are financing U.S. debt. And so because of these trade deficits, there's high current consumption at the expense of future consumption and a high amount of debt. The U.S. is the world's largest debtor nation. Foreigners own a lot more of U.S. assets than U.S. citizens own in foreign assets. Okay, this concludes chapter 39.